For the next, let's say, 20-25 minutes, I want to give you some highlights of our investment outlook on Triodos Investment Management. And the theme we have chosen for this year was about trust. So I first will go into trust and why this is important, then our outlook, and then, since we are at Triodos always interested in the long term and in transformations, transitions, my last part will be about the longer term. So investment at Triodos, impact investing with all the funds we have is definitely not always only for the short run. So not only about 2022, but of course the returns we make and the performance of our funds is related to market circumstances. So we will try to discuss everything. But to take a starting point, but about well-being, I noticed something when I was doing Google Trends. Sometimes I do that and put in economic growth and well-being. And what we saw, and that's the spike in the beginning of 2020, is that well-being was searched more often than economic growth. That could mean two things. The one thing is everybody knows what economic growth is about. But my other interpretation is that well-being has become more important, especially in the first lockdown. You remember the quiet lockdown when we were still happy and a little bit afraid what was going on. And well-being as a central theme is what we invest for. We invest in impact for the sustainable future, and this is really about well-being. But a lot of the discussion in the short run and in economics and in financial market is about the economy in metrics like economic growth, inflation, and interest rates. And of course they matter. They matter in the short run. And that's why we also use this normal economist lingo in Triodos, because it steers the market and it determines in the short run material well-being. But in the end, it's about a broader idea of well-being where we invest for. So this is to start. A second starting point I want to make is about trust. Trust, and we see different levels of trust. Trust is basic trust in others and institutions as a foundation for society. That's important, how the economy, how society develops in general. And this foundation of trust is even more important, I think, in the next few years, or even at the moment when we see the tensions in Ukraine between China and the US, etc. So basic trust is important for how the economy develops. Within that trust circle is confidence in each other based on what we normally can expect from each other and based on shared norms, which is also important to have that kind of confidence in that the economy will develop. And the smallest definition of trust, that's what always drives markets, that's about sentiment. And what I want to say with this picture is that these different levels of trust are very important, both in the short and the long run, and determine for a large part our outlook for this year. So going to our outlook, what we see happening is that the recovery, like we've seen in 2021, and I'm speaking really about short term and about economic growth, goes on. But risks are emerging, and I will discuss them later on one by one. But what we have seen in 2021 was a recovery driven by stimulus of governments, by what we know as rebound effects. So we had a severe recession, and then we recover, which is kind of automatic in an economy. And we expect in our forecast that trust, so the basic component of trust, will not move below a threshold required for the release of a lot of money people have still in their pockets and can spend. And what we also expect in our central forecast is that supply constraints will ease, that inflation will gradually fade out, and that central banks will still be more accommodative than expected by markets, but will start to hike the interest rates. But trust is that COVID-19 in the end will fade away. And that's kind of strange. If you look at the graph on the right-hand side, you see that the COVID cases at the moment are higher than ever. So we went from Alpha to Delta to Omicron with a few Greek letters. We don't know what they were in between. And we see that symptoms of COVID have changed. I'm an economist. I'm not a medical expert. But what we see from an economic side, that every wave has economic consequences, but the effect diminishes. And that has two reasons. The one is we learn to adapt, and the second one is the effects of the variant, especially Omicron, are milder than before. But in general, what we see, lockdowns hit travel, hit leisure, hit trade. And also what we see that every new wave leads to higher debt for governments and private persons and firms. So we trust in the end, and sorry that's in Dutch, apologies for that, but that COVID in the end will fade away. And what we see in our growth forecast, this is for maybe a little bit cryptical figure for a lot of you, but if it's up, it's good. If it's below zero, it's bad. And that means 2020 was the year of the recession for the US, the Eurozone, and Japan, and the UK, what's in here. And that 2021 is the year of the recovery, especially what we saw in the US. And 22 will also be a year of a recovery, but to a lesser extent than last year. And that's driven by the fading away of the rebound effect and also some other factors. But what we see happening coming year and what will still remain is that if everything goes well and people have trust, they will start to spend. We see globally excess savings peaking, and that's in that figure. And that if consumers really have the confidence, they will start to spend. For investments, that's the same. If firms have the confidence, and confidence is, like I said, a little bit different than trust, or to speak with John Maynard Keynes, if they have the animal spirit, so the gut feeling, that it will be all right, that they have reasons to build up their capacity, they will start investing. And for almost all rich countries, this picture looks pretty good. Also from a government perspective, also in Germany, but also in France, for example, governments want to invest, for example, in an energy transition, in climate, but also in innovation, infrastructure. But on a different note, emerging economies, so let's say the rest of the world, is a completely different picture. Lower vaccinations, less government support, and also higher inflation, which make the outlook for emerging markets less positive, especially for the people living there, than for Europe. So, and also from an investment perspective on that. And the big question is, in a lot of newspapers, but also in the markets last month, is inflation. First, we had the inflation story. It was all transitory, so that it would all fade away pretty soon, and we expected it to fade away in fall already. But now reality kicks in, and we see it's not fading away. So there's a lot of turmoil on the markets, also related to the response of the central banks. So the trust that inflation returns to normal is still the central forecast of almost all policymakers. But transitory, which means very temporary, is not anymore the case. It's getting longer and longer, that transitory idea. And there is quite a difference in that between the US and the Eurozone, where in the Eurozone you can see it's mostly energy prices, commodities, where you can see so imported inflation, while the wage price spiral in the Eurozone is not going anywhere at the moment. So wages are pretty low, which is not good for the purchasing power of a lot of consumers, but is good for the long-term inflation perspectives. While in the US, we see happening that also there's wage pressure building up and longer-term inflation can be expected. But in general, we still think normalization this year with clear differences in the nature of inflation between continents. And this makes it quite interesting from a financial market perspective if we look at what's happening at the moment at central banking landscape. So this is a picture of the different presidents of the Fed, the central bank of the US. So we had Paul Volcker in the early 80s. He hiked the interest rates really high to combat inflation. And he was successful at that, at the cost of an economic recession. And we saw, and that is the funny part of this picture, that the presidents get smaller and smaller, and the interest rates on average was lower and lower. And now we have Jay Powell, who will start definitely to raise the interest rates this year, priced in 5 to 6 times. And that also relates maybe to his personal height. We don't know yet, but that's the market expectation. So a quite different investment environment on the central banking side than we had, let's say, for the last 40 years. And that makes markets quite nervous. Because the big question is the trust that central banks will not normalize too fast. They have a very big balance sheet, that is what you see on the upper right-hand side, and very, very low policy rates already for a long time. Here also the last 40 years where you see a tendency to lower and lower interest rates. For them, for central banking policymakers, it's important that inflation expectations remain anchored. And by that we mean 2% or a little bit below 2% in the longer term. And to get there, at least the Fed is expected to hike the short-term interest rate, so the policy rate, at least 5 to 6 times this year. And that might lead to an inflation which is currently at zero at the short end. That might go to somewhere between the 1.5 and the 2%, which is now currently the 10 years in the US. So quite a different interest rate environment can be expected this year. And from the other aspect, what we have seen unprecedentedly also, apart from the monetary policy, the public policy, so the public spending, especially in the US, since Joe Biden arrived in the White House last year, we spent trillions of dollars, or at least started to spend trillions of dollars to boost the economy. And this is also what you see in this picture, that governments also in Europe will spend less more, so they still spend a lot of money. It's not that they're going to do austerity, but if you spend less more, it adds less to growth. So you have to spend the same amount to have the same level, and you have to spend extra to contribute to growth. And that's not what we see happening. And for public policy, so for governments, it will be an interesting year, especially in the Eurozone, and it also relates to the investment landscape. For one, the Sustainability and Growth Pact, so we know the 60% debt rule and the 3% deficit rule in the Eurozone. We have to invent something new. That's at stake. Also, Germany is very important in that discussion. And of course, Germany is important. And for Dutch people, it's quite getting used to also a new German government. We were used that the Germans were the most frugal and then the Dutch could join. And that's not anymore the case, or that's a little bit different. So we see a new discussion emerging there, governments willing to spend more and I think that from a Triodos perspective and also from an investment perspective, that's a good idea to spend on transitions, on, like I said before, on energy transitions, on climate, on sustainability in general, but also on innovation infrastructure to help the structure of the economy. And that will be very interesting how that will work out in the coming years, because it has to go hand in hand with the discussions about how private companies like Triodos invest. So that's what we call, for instance, the taxonomy, so the green spreadsheet of the European Commission, what defines what is sustainable and not. Maybe you've heard about the discussion of nuclear and gas, should it be in or out? It's a very interesting discussion. It relates to what we do as an asset manager, but it also relates to what governments do. And that combination, what we call blended finance, has to become the solution to a transition to a more sustainable economy. So this is a very, very interesting topic for the coming years. And in general, we trust that governments will keep on stimulating. Completely different in emerging markets. There we have big problems, and we see poverty rising. And it's different than we have seen before the pandemic, when we have seen years and years of lower poverty, absolute poverty, and a lot of emerging markets that perform better and better. We see now that the trend is broken. And so we still trust that inequality remains limited, but this is a big worry if we also see it in vaccinations. Another trust is that the inequality between big and small becomes less. And with big and small, in this case, I don't mean big and small countries, but big and small firms. We see the biggest and biggest firms are the winners of the pandemic. Last month was maybe a little bit different in that trend, but not for Apple, for instance, who also gained a lot. We see the market power of very big companies at the same level as we have seen in the early stages of the 20th century when we first had the railroad companies, then the oil companies, so real massive and too powerful firms which capture too much profits. And what we see also is that inequality between generations is increasing. We see it in public debt is rising, and who pays that public debt in the future? Future generation. We see increasing private debt. Who pays the debt? Future generation. And we see also in a lot of countries increasing house prices, which is nothing else than a transfer from young to old people. So there will be, and I'm not talking about climate because that's also inequality between generations if we don't solve this in this generation. And of course, 2021 was the year of the two rich people going all to space for no reason, or in other words, the wealth of the top 0.00001% as a share of total US wealth in this case, although they lost quite a few billions in the last month, is really, really absurd. And that all relates to the previous points of big companies becoming too powerful. My last part of my story here. So this was about the short run, a short overview about what we expect for 22, and there's a lot of trust in, and I still want to trust. Trust is, of course, also partly another word for worry or uncertainty, because there are a lot of caveats. I did not touch upon the geopolitical problems we currently have, which feed in, for instance, inflation fears. If Russia invades Ukraine, we probably have a problem with our energy supply that will lead to higher inflation, that will lead to other reactions from central banks and policymakers. These are all worries, and that leads to repercussions on the markets. But that's always the case. And sometimes in the years before, we saw all those worries were not worrying the financial markets because they had central banks and monetary policymakers doing the trick, which meant that it did not lead to any market reaction because they knew there was enough liquidity. And now that we have taken the turn a little bit already, that the accommodative policy has become less, we might expect that financial markets will react earlier to geopolitical tensions. But now we go to the long run, because in the end we invest for the long run. And one point we made in our long-term outlook, and this also relates to what we expect from our investments in the longer term, that we really have to rethink economic growth. Because it's very clear 50 years after the publication of the Limits to Growth book, that the economic growth or the economy itself has a limit. If we saw in the summer last year the effects in Germany and Belgium, what happened with the floodings, extreme heat, etc. You all know the story, biodiversity loss. So we have to, also as an investor, as a bank, we have to relate to those planetary boundaries. And like all asset managers do when they discuss their products and say, yeah, you can expect a long-term return of this or that percent, they make a big mistake, in my opinion. And this is quite, I have to express myself quite carefully. Because what they do what we economists call growth accounting. So they take the average expected economic growth, they add inflation and say, this is what you can expect from the longer term returns given where markets valuations are at the moment. But if they do it, they still expect that economic growth can go on as nothing happens. But if you take sustainability seriously, you have to relate to those planetary boundaries. And in that case, I can see only three scenarios, and I try to depict it here, which is a graph with GDP and natural inputs on the axis. The one is we're going to a circular economy, which means growth with less material inputs. So a lot of technology, a little bit utopia, but to be honest, not enough evidence. Then we have a steady state scenario. A steady state, which means not a shrink of the GDP, so of the economy on a macro level, but also not an increase, and with less natural inputs, because that's where we need to go to. And then we have a degrowth scenario, smaller economy with less natural inputs, but in the end, hopefully also sustainable. We don't know at the moment what the answer is, but what we try to do is at least to invest in transformations that lead to a more sustainable economy. So we don't concentrate on that macro level because we question if you can achieve an ever-growing economy. So that's also not what we say to our clients. And the way we try to do it at Triodos at the moment, sustainability is interconnected. It's an interconnected problem with different elements attached to it. So on the social side, on the planetary boundary side, and for the moment we decided we have to concentrate with all we do on climate change. And we call it as 1 to 0, because we know we have to do it as one, as a bank, as an asset manager, with all the funds we have. We have to do it taking account of all the different elements of sustainability, but also with our clients, with our investments, with our engagements, with everything we do. But this is the focus point we chose as one that is the most prominent, what we want to achieve, and not forget the rest. And this is my last slide on it. And what we see here is that if you think about transformation, so I used interchangeably the words transition and transformation, and by transformation I mean a series of transitions. We see 3 big transitions. The first one and the most important one at this moment is the energy transition. The goal is simply reduce carbon emissions. And we try to contribute to it by reducing our own footprint, by investing in renewable energy, and by investing in sequestration or other net zero carbon positive initiatives, rewilding, etc. Second one is the resource transition, also called circular economy, reduce in use of non-renewable resources. And the third one is the food and nature transition, and it also has a part regenerative nature in it, what I said, that helps to have carbon positive investments. And it all has to be inclusive. And as a final remark, this will only happen if there is trust, if there is trust of clients, of society in those transformations. And that's also not a role for finance alone or for Triodos or sustainable investors. This can only happen if the public, if governments, if everything is aligned and we try to do it together. So this is more the long-term view we have on how we invest with our funds in different transitions. Maybe as a last, my final slide, this is the way we try to invest. I started with the short run, with the everyday problems, I would like to say, and try to end a little bit with our long-term view. I know it's very short, but it was the intention after dinner to do it in this way. If you want to have a longer view, you can all find it on our website. And that's it from my side at the moment. Thank you.